We're joined by INSEAD Professor Lily Fang. You've brought out a study with two co-authors from Harvard University. The study's called An Unfair Advantage, Combining Banking with Private Equity Investing. This study has come out at a time when the Volcker Rule has been put forward and Congress is looking at how it can limit investments by banks. Was that coincidental?
So we are certainly quite lucky with the timing of the paper. We started this paper last year in 2009 and early 2009. At the time, the Volcker Rule hasn't been talked about. In fact, the phrase Volcker Rule hasn't been coined. And a year later, essentially earlier this year, 2010, we had our initial draft ready, and that was the time when the Volcker Rule phrase was coined. As President Obama announced sort of consideration of the Volcker Rule, which would essentially curtail private equity and hedge fund investments in the banks.
What were your main findings then in the study?
Our study actually compares the financing and performance of private equity deals done by bank-affiliated private equity groups. So for example, Goldman Sachs Capital Partners. This group would be considered a bank-affiliated private equity group versus standalone private equity groups such as Blackstone. So first of all, I myself was actually a bit surprised by how extensively banks were involved in private equity investment. And there's a high concentration in activity as well. Goldman Sachs, for example, alone accounts for more than a third of all the deals done by bank-affiliated groups. So just in terms of the sheer size, banks are actually quite significantly involved in private equity activity, which I mean, my own prior would be maybe 10%, but we found it's more like in the order of 30%. So that's interesting. And secondly, we find that, in fact, and also, this is also a big deal for the banks themselves because essentially they were employing about 10% of their capital in these type of activities. So it's certainly significant both for private equity activity and also for the banks. That's one thing. And we also find large, very pronounced cyclicality in banks' involvement. And this is very interesting. So essentially, we already know from prior research on private equity that the private equity industry itself is very cyclical. We have the underlying private equity activity being very highly cyclical, and precisely at the peaks of these markets, the banks actually do a higher fraction of the deals at these times. On the one hand, it could be that the bank's willingness to lend or to arrange for lending signals that this is a high quality deal, and because of the merits of this deal, it was able to get better financing terms. So that's sort of this information advantage theory that we have for financial intermediaries and for banks. So it's a good reason for this to happen. On the other hand, it could be a bad reason. It could be an so quote unquote unfair advantage, which is the phrase in our title, which suggests that this is actually because the banks banks themselves can borrow at a better rate than the rest of us can in the economy, and then it turns around and gives this to its subsidiary, in some sense generating an unfair advantage. So in some sense, we do find that the banks seem to be able to take advantage of the cheap credit at the peak of the market, and essentially that benefits the financing of the private equity deals done by their private equity subsidiary.
Why were the banks then so prepared to invest in private equity funds?
There certainly could be many reasons. So banks are constantly seeking different ways of generating revenue and profit, and having a principal investment arm, whether being a hedge fund operation or private equity operation, it essentially gives them another way of wagering their own capital and essentially try to profit from that. And to the extent that banks always enjoy being the central information clearinghouse, if you like, for the financial system, it always has some kind of information advantage, and it may put itself at advantage in terms of kind of creating profit from these operations. Companies may want to diversify into different activities to have a larger profit base. And if they have a certain advantage, in this case, it's information, they would have a natural tendency to want to get into these activities. Now, on the other hand, there's certainly elements of kind of trend chasing or herding behavior going on as well, because we see that they do more of these private activities precisely at the peak of the market, when these seems to be in vogue and these seems to be easy to finance. There is not only the opportunity, but also seems to be the attractiveness to do so. So there's also that element to it.
So in essence, you're saying that the private equity funds were getting an unfair advantage because of their links with banks.
Right. In some sense, we argue in the paper from the empirical evidence that we have, essentially that the concerns that regulators have in terms of allowing banks into different risky opportunities, especially given the fact that banks do enjoy this implicit subsidy by the taxpayers and they have low cost of capital, it does seem to be these concerns of risks associated with combining various activities do seem to be quite well justified.
So does the Volcker rule, which is essentially trying to cap banks' investments, does the Volcker rule go far enough?
I think that we should look at the Volcker rule as trying to reduce the complexity of financial institutions. Essentially, it's saying that if certain institutions are enjoying, taxpayer subsidy implicitly or explicitly, we cannot have situations such as too big to fail. If anything, our study shows that we have a big knowledge gap in terms of these very complex investment, and our study is really one of the first attempt to try to shed some light on the subject.
Lily Fang, INSEAD Professor, thanks for joining us.
Thank you.